A dividend is a payout from a company to its shareholders, usually paid in cash or reinvested. Think of it as your reward for owning a piece of a profitable business. Here's how it works. The company makes a profit. The board of directors decide to return some of that profit to shareholders. They issue a dividend, typically quarterly, and you, as a shareholder, receive that money directly into your brokerage account. So for example, you own 100 shares of a company that pays 50-cent quarterly dividends. That's $50 every quarter, $200 per year, just for holding the stock. Now, not all companies pay dividends. Generally, mature, profitable companies like Coca-Cola, Procter & Gamble, Apple, they pay dividends regularly. Here are the key terms you need to know. Dividend yield. This is how much you earn annually compared to the stock price. So for example, a stock at $100 that pays a $4 a year, that has a 4% yield. Payout ratio. This shows how much of earnings the company is paying out. A healthy payout ratio is often a sign of sustainability. Ex-dividend date. You must own the stock before this date to receive the dividend. You can also reinvest your dividends automatically using a DRIP. This allows your dividends to buy more shares, which then generates more dividends, and the compounding begins. Now let's talk about why long-term investors love dividend-paying stocks. Passive income. Even if the stock doesn't move, you're still getting paid. It's money showing up in your account every quarter. No selling required. Compounding growth. Reinvesting dividends accelerates your return. So over time, that $100 payout becomes $150, then $200, and so on, without you adding another dime. Quality signals. Companies that pay and grow dividends consistently are usually financially strong. They have reliable profits and disciplined management. Better long-term returns. So historically, dividends have accounted for 30 to 40% of total market returns. They're not just a nice to have. They're essential to maximizing portfolio growth over years. If you had invested $10,000 in Johnson & Johnson back in 1990 and reinvested the dividends, your portfolio would now be worth well over $200,000. Without reinvesting those dividends, closer to $90,000. That's the power of compound interest with a dividend behind it. Dividends pay you to be patient. They give you income, stability, and compounding power all in one.